Hi guys, welcome back to Target IAS. This is Neha Bolgam and today we are on the third episode of the Government Schemes series, and today's topic of discussion is the Ministry of Finance. For the viewer information, we have already discussed the Ministry of Science and Technology in our first video and the Ministry of Social Justice and Empowerment, Ministry of Women and Child Development in the previous video. That is the second video. So let's delve in. The discussion of the schemes under the Ministry of Finance in this video is going to go about the same way as I have done in the previous two videos, where we tell the scheme, talk about its objectives and major facts that include the eligibility criteria and progress thus far and etc. Now, the first scheme for today is the Pradhanmantri Kalyan Yojna, which has been introduced with the objective of being as an umbrella scheme that has been introduced post the COVID-19 pandemic. That means it has been launched in the year 2020, and we are discussing it in this year because it has been extended until 2021. Let us go into the details of the scheme. As I told you, now this scheme has been introduced for 2 months, that is May and June in 2021, in the backdrop of the resurgence of the second wave of COVID. And this scheme was primarily launched to supply free food grains to migrants and poor who faced hardships on account of economic disruption caused by COVID-19 and the lockdown. And its main features include distributing 5 kg free food grains throughout the 2 months, and that is to the target population of 80 crore beneficiaries. And the cost of the food grains of this distribution scheme is to be entirely borne by the central government. Now, the second segment under the Pradhanmantri Kalyan Yojana is the insurance scheme, where any health professional, while treating COVID-19 patients, meets with some accidental loss of life, then he or she would be compensated with an amount of 50 lakhs for 90 days. And this is especially for the public healthcare providers and community healthcare providers. Now, going ahead, the second scheme is the Safe Plus scheme, which is by the SIDBI assistance to facilitate emergency response against COVID-19. So, as you've noticed by now, the first couple of schemes in our slide here are related to COVID, and that is why I'm discussing them at the forefront. And here SIDBI, as you all know, is abbreviated for Small Investments Development Bank of India. And under SIDBI's assistance, this scheme focuses on the MSME sector. Let me discuss the details of the scheme with the help of the infograph here. So under SIDBI, we have the scheme divided into 3 parts, that is the Safe, Safe Plus and Smile scheme, with our primary focus being on the Safe Plus scheme. And the key features of it are a loan of rupees 50 lakhs is provided under the Safe scheme that I have discussed the first one. This is the second one and this is the third one. Whereas under the Safe Plus scheme, which is the focus of today, a loan of 400 lakhs and under is provided with an interest rate of 5%, with no processing fee, no prepayment charges, and cost of credit guarantee is also being borne by SIDBI. There is this turnaround time of within 48 hours. Before going ahead, let me clarify what this turnaround time means. And this is nothing but the amount of time taken to complete a process or fulfill a request. And in this case, it is the application for the loan. So the turnaround time here is within the 48 hours. Thus, the repayment of the term loan can be done up to 5 years and the working capital loan up to 18 months under the Safe Plus and Safe schemes, which is especially for the MSME sector, which is to be remembered. The third scheme under the Ministry of Finance is the Pradhanmantri Yojana, and this supports the finance institutions which are in the business of lending to the micro or small business entities engaged in manufacturing, trading and service activities. So this objective has 3 parts to it, where the government here supports the financial institutions which lend to the micro and small business entities, and these businesses are engaged in the manufacturing, trading or service sectors. Now, key facts to remember here is that these loans are collateral free and are majorly divided into 3 types. Before discussing the types, let us on the outline understand what the Mudra scheme entails. So as you can see here, it is the tagline is the funding the unfunded and the indigenous financial engine. Before going into understanding the features of the scheme, you have to know that Mudra here also has an abbreviation, which is the Micro Units Development and Refinance Agency, whose features include regulating and refinancing all the microfinance institutions. This has a corpus fund of about 20,000 crores, and it has a partner with the state level coordination and will create good architecture of last mile credit delivery to microfinance businesses, and etc. And as you know, since it is a last mile credit delivery, it of course has to aim all the local small scale vendors such as the shopkeepers, fruit and vegetable sellers, beauty parlors, truck operators, hawkers, artisans, and etc. Now, one point here is that I have told you that the banks have been mandated by RBI to not take any collateral upon this loan. And to mitigate the issue of collateral and to provide security to these lending institutions, a credit guarantee product is extended by creating a fund called the Credit Guarantee Fund for Micro Units by the government. Now, coming to the three types of loans to be allotted by the micro unit developments and refinance agency banks are the first one being the Sishu loan, which provides up to Rs 50,000 for startups and first time entrepreneurs, and the second type being the Kishore loan, under which the limit has upped to 50,000 and 5 lakh, and under the third type, that is the Tarun loan, it is further upped to 5 lakhs to 10 lakhs. So the major things you have to remember is the numbers, where the first loan is up to 50,000, the second loan is from 50,000 to 5 lakh, and third loan is from 5 lakh to 10 lakh. Now let us look at the result board of this particular scheme. So with 2021, it is 6 years of implementing the Pradhanmantri Mudra Yojana, where about 68% of the loans have been given to women entrepreneurs, 51% given to the SC, ST and OBC borrowers, and 11% given to other minority community borrowers. So they're just trying to show that it is a very equitable loan which does not have biases. Next up here we have the Pradhanmantri Jan Dhan Yojana, whose objective is majorly financial inclusion by providing universal access to banking facilities. So as its major objective is financial inclusion, under facts the first alleged sense-making eligibility should be that the person should be unbanked, meaning he shouldn't have an account with any of the banks until now. And this scheme has been launched in 2014, and again, as the Mudra Yojana, 2021 is it being completely successful for 6 years. And let us discuss the features of the scheme. Under the Pradhanmantri Jan Dhan Yojana, so before the scheme, the challenges within was there was financial exclusion, where there was leakage in the subsidies given to the farmers and the rural area schemes. The benefits were not reaching to the target population due to the beneficiaries especially not having authentic bank accounts. So this was the problem that has been identified by the government, and this has been addressed by introducing the Pradhanmantri Jan Dhan Yojana, which aims at financial inclusion. That means, as I just told you, it is the universal access to banking facilities with at least one basic banking account for every household. So this induces financial literacy, access to credit, insurance and pension facility. And these are the other key features, such as accounts can also be managed on zero balance. No minimum balance required. So there is interest given to the rural people on the deposits that they make, and an account can be opened in any branch in the area. And it also has the accidental insurance cover of Rs 1 lakh. It has life insurance cover of 30,000. As I've told you, the problem is that a lot of beneficiaries not getting these subsidies because of lack of banking accounts has been solved here, where the beneficiaries of the government schemes will now get DBT, that is the direct benefit transfer, which is a key feature in financial inclusion. There is access to pensions, insurance products, as we've just discussed. And there is also overdraft facility up to 5,000. There is a feature of easy transfer of money across India because of, now that the bank accounts are everywhere, even in the rural areas, the risk of carrying money in huge lot of amounts by hand and thereby increasing rate of crimes within the inter-village travels due to robbery and thefts would reduce. And it is also instant transfer. For example, when there is any emergency need, you do not have to take all the money by road and etc. Now, and as we have just discussed the credit guarantee fund for micro units under the Pradhanmantri Yojana, I thought I would also bring in discussion the fifth scheme for today, that is the emergency credit line guarantee scheme, under which 100% guaranteed coverage to banks, NBFCs, that is the non-banking financial facilities, and other businesses and MSMEs hit by the COVID-19 is the priority. So this is again a COVID-19 introduced scheme which is important for your answers, as is the Garib Kalyan Yojna and the Safe Plus scheme. So as I was saying, similar to the credit guarantee fund for micro units under the Pradhanmantri Yojana, the ECLGS, that is the Emergency Credit Line Guarantee Scheme, has the National Credit Guarantee Trust Company Limited, which covers the loans that are being provided by these particular financial institutions. Now let us go into the features. Now the government has periodically announced the ECLGS, that is the Emergency Credit Line Guarantee Scheme 1.0, 2.0, 3.0 and 4.0 in tranches. So the Emergency Credit Line Guarantee Scheme has been providing credit to entities that have an outstanding credit of up to 50 crores as of 2020, with an annual turnover being rupees 100 crore and the moratorium period being 1 year and the repayment period being 4 years. So these are all the key features of the first tranche introduced in the year 2020. And moving ahead, the second tranche has almost the same features, but just that the lending schemes have been extended to further 26 identified sectors by Kamath Committee in the healthcare. And under the Emergency Credit Line Guarantee Scheme 3.0, we again have the same 100% guarantee provided to enterprises in the hospitality, travel, tourism, leisure, sporting and civil aviation sectors. So remember the sectors here. And under the fourth tranche, we have 100% guarantee again, but with a cap of rupees 500 crore loan outstanding for eligibility, and the sectors that are covered again here are the same: hospital, nursing, clinical, medical units, etc., that are engaged in the manufacturing of oxygen cylinders and plants, oxygen compressors and etc. So one key factor that you have noticed as the scheme has evolved from 1.0 to 4.0 is that the lending capacity has increased, and also the number of sectors that have been covered has evolved. Now going ahead, the sixth scheme of today's discussion is the StandUp India scheme. Now here the objective or the target population is different, and please keep this in mind. This feature is what differentiates it from all the other schemes that we have discussed up until now. So here the scheduled commercial banks are provided to give loans to the scheduled caste, scheduled tribes and the women categories. And under this, the eligibility or the facts of the scheme are that this have to only be greenfield projects, and let me put a word here that greenfield generally describes a completely new project that has been executed from scratch. And opposed to this, a brownfield project is something that has already been existing and has been taken up for renovations and repatriations before bringing it up. So under this, the StandUp India scheme only provides finances by the bank to the SC, ST and women communities if it is a new project. And the borrower, another key fact for eligibility is here that the borrower should not be a defaulter in any bank. And 10% of the project cost must be their own contribution. And another factor here is that need not that when they pick up a project, all the members in the project have to be people from SC, ST or women communities. It is just that at least one person who is a lead partner or contributing majorly to the project has to belong from any of the three communities. So let us look at an infograph for a better pictographic memory of this. So as I've told you, under the StandUp India scheme, it is so one key feature going ahead with the StandUp India scheme is that here the government does not allocate funds as in the previous schemes, where it is also the guarantor of the funds that is being lent out by the banks, whereas here it is solely the banks that provide these loans to the target sectors, that is the scheduled caste, ST and women populations, and again the manufacturing, services and trading sectors. And the bank loans are between 10 lakhs to 100 lakhs. This is the limit of provision. And these are composite loans which are inclusive of the term loan and the working capital. And I would want you to remember certain steps taken by the government. Since I've told you it has not provided any funding to the scheme, it has still provided certain steps in proper and effective implementation of the scheme, with the first being the provision for submission for online applications by potential borrowers through the www.standupmitra.in portal. And government also provides the hand-holding support in this scheme, which has not further been defined. This can be taken up as a challenge or a limitation of the scheme, and it also helps in publicity campaigns and simplification of the loan process and etc. So up until now, the total number of sanctions done under the scheme are about 1 lakh, and the sanctioned amount being 23,000 crores something. So another key feature you have to remember about StandUp India scheme is the loan is repayable in 7 years with a maximum moratorium period of 18 months. And ask me why are we discussing the scheme here is because the scheme has been extended until the year 2025. And going ahead, we have the 7th scheme, which is again a very recently introduced scheme in the 1st of January 2021. The scheme is the remission of duties and taxes on exported products. So the main objective here is the reimbursement of the taxes, duties and levies that have been put on all the export goods. So the scheme and the reimbursements that are done under the scheme to the exporters are all WTO compliant. And an important feature of this is that it replaces the previously existing MEIS and ROS CTL, which is the merchandise export from India scheme and the rebate of state and central taxes and levies. Don't worry, I will talk about it in detail. So as I've told you, the RODTEP or the remission of duties or taxes on export product schemes replaces the MEIS. Let me write it for you. This is the merchandise exports from India scheme. So this was essentially an incentive scheme where exporters, let me draw a flow graph here for you. So here the exporters that export goods and services receive a duty credit scrip from the government. And these scrips are primarily used for paying a variety of these tax and duties. So, okay, let me explain to you in simpler words. The duty credit scrips are nothing but an export promotion benefit, okay? So the duty credit scripts are nothing but an export promotion benefit scheme which can be used by the exporters to set off a couple of their import duties. So as they export, they pay, they get levied, cut. So as they export, they cut. So as they export, they get levied by the government, which they in turn use to pay off on their import bill. Having understood what the scheme is and what is the duty credit scrip, that is the main feature of the merchandise exports from India scheme, let us understand why a WTO panel has ruled out that MEIS was incompatible and why it had to be replaced. So basically it is that the multilateral trade rules, as it could not be directly correlated to the input tax paid by the exporters. So having understood what the MEIS scheme is and what are the duty credit scripts, that is the main feature of the scheme, let us understand why this has been replaced. So as the WTO panel, that is the World Trade Organization panel, opines, the MEIS scheme was incompatible. On what grounds, you ask me? Especially with the multilateral trade rules, as it could not be directly correlated to the input taxes paid by the exporters. So this discrepancy between the multilateral trade rules and the input taxes paid by the exporters has led to the replacement of this particular scheme with the remission of duties and taxes on export products. Now in the chart above, I have also told you that this has been replaced by another scheme, that is the rebate of state and central taxes and levies scheme. Let me discuss here briefly what this scheme is. This has been announced in the year 2019, and the scheme was offered for embedded states and central duties and taxes that are not refunded through the GST tax. So this transition is a very positive transmission, as the incentivizing of the exporters is more than any of the other current schemes that have been in work until now, and the improved incentives will cost rupees 50,000 crore annually for the government, and the scheme is totally implemented by a fully electronic method. And I would make a last comment that the remission rates here are to be decided by the Department of Commerce, of course again based on the recommendations of a committee chaired by G.K. Pillai. Please remember the committees that I am mentioning and make a note of them somewhere. And under the last segment of our today's discussion, we have the Pradhanmantri Yojana and the Atal Pension Yojana, which by the name are quite clear that they target the elderly population in the country. So the Pradhanmantri Yojana provides social security to elderly through pensions by the Life Insurance Corporation of India, and it is only to the people who are aged 60 and above. Let us go into detail and discuss the other features of the scheme. So as I told you, the eligibility of the scheme is 60 years and above with a 10-year subscription maximum, and the minimum installment that goes into the scheme by the subscribers is 1.5 lakh and the maximum is 15 lakhs. And for this installment that they make, they receive a maximum pension of 10,000 and a minimum pension of 1,000. And the exit policy is also quite liberal, where there is only a 2% penalty on the subscribers if they want to exit the scheme before they attain the required age to get the pension back. Now, why is this particular scheme in discussion in this current video is that the rate of return here in the year 2020 has been recently amended by the Union Cabinet and being brought down to 7.40%, making in line with the small savings scheme interest rate. And the scheme has also been extended to the year 2023. In the year 2019, there is also another criteria here, that is the eligibility based on Aadhaar submission, which has been made mandatory. Now, under the Atal Pension Yojana, we have the subscribers being provided with a fixed minimum pension at the age 60. And the major difference between the Vaya Vandana Yojana and the Atal Pension Yojana being that the second scheme focuses on the unorganized sector, and the age eligibility is between 18 to 40 years, in where the above case it is only 60 years and above. And also the minimum subscription period being 20 years under the Atal Pension Yojana, with 10 years being the minimum subscription rate under the Vaya Vandana Yojana. Now, going into the scheme and its features, this scheme has replaced the Swavalambhan scheme, which is also called as the National Pension Scheme. And since this scheme takes under the age group of 18 to 14, the Swavalambhan scheme, which it replaced, has retained with it the people who are above 40 years, and other features being that the monthly pension under the Atal Pension Yojana is being provided in the dividends of 1,000 to 5,000 depending on the scheme they choose. Another unique feature is that 50% of the basic premium is being paid by the government for the first 5 years. And the exit scheme here is voluntary with no penalty. Also, in case of any death of the subscriber, the spouse will be entitled to receive the pension wealth as accumulated until the 60 years. So that's it, guys. Before leaving you with all the loaded information that I gave you for the day, please just go back and revise one slide by another. You do not even need to go through the whole video. The infographs and my markings, my notes on it is quite enough for you to repeat them and understand them. These are the prelims practice questions prepared by the institute for the exam. So and these are asked purely from the schemes that we have discussed today. So the first question is the Emergency Credit Line Guarantee Scheme, the ECLGS that we have discussed at the start of the video, has been extended to support 26 stress sectors. If you remember, this has been done in the second tranche. Now, these identified sectors have been by which of the following committees? Is it the J.K. Pillai Committee, the Kamath Committee, Ashok Dalwai Committee, or the Malegam Committee? And the second question being from the ROTEP scheme, that is the Scheme for Remission of Duties and Taxes on Exported Products. And the question reads, this scheme has replaced the rebate of sale and central taxes and levies because it was incompatible with multilateral trade rules and could not be directly correlated to the import taxes paid by the exporter. Now, all these sentences sound heavy, but remember, I have just demystified all of these terms for you in the slides above. So if you have a doubt with this question or in solving this question, please go back and revise and let me know the answers in the comments section. So that's it, guys. Thank you for joining us on today's video, and look out for our next week's video, which is on the Ministry of Agriculture and its associated ministries such as the fisheries, animal husbandry and food processing industries. So I hope you bought something out of this video. Please do let us know it in the comments and also answer the questions that I have provided to the end. Also, any other suggestions regarding any other ministries to take up or schemes are welcome. With this, I sign up. Thank you.